Hi, everyone. Thanks for joining. We're excited to for our presentation on essentially beyond DAFs and just really diving into which charitable strategies there are and what makes sense for you. We're going to give people 2 minutes to join before we get started. In the meantime, just let us know if you can hear us by letting us know where you're joining from. I see Tom joining from Portland. Let us know in the comments where you're joining from as well.
Santa Barbara.
That is Peter's neck of the woods. I'm joining from Florida, and Peter's joining from
I'm in LA.
LA.
Yeah. My grandma used to live in Santa Barbara. It's a beautiful, beautiful town.
Well, I guess we'll give folks another minute to join, and then we'll get started. In the meantime, if you just joined, let us know you can hear us by letting us know where you're joining from. East Bay. Very nice. I used to live in San Francisco. California taxes actually are what got me to look into things that drove me to start Valur. So, all right, perfect. We're going to get started. First of all, thanks for everyone joining. We know everyone's got a busy schedule. Today, we're really excited about the topic. It's beyond DAFs, and it's really diving into different charitable strategies to help understand which charitable strategy makes sense for you. And really, the whole point is people think of charitable strategies as just purely philanthropic, which kind of DAFs have come to embody. But charitable strategies can range from very selfish, with a small charitable component, to purely charitable, to charitable plus there's kind of social and personal branding value. Really, we're going to dive into those different options, help you understand them, and help understand what makes the most sense for you. Just a few kind of comments before we get started is one, please, if you have questions or topics related to this whether it's kind of upfront that you want us to dive into or as we're talking about it, please let us know in the chat. We'll try to answer questions as close to when we read them or when it's appropriate if we're going to talk about it later in the presentation or at the end. And just kind of a quick blurb about Valur, and then we'll dive into kind of Peter and I. So I founded Valur, and the whole idea is to help everyone really understand what are tax mitigation options out there. Historically, these options have only been accessible to billionaires and people with large family offices. The idea behind Valur is how do we help between education, such as this webinar? We have a lot of free content. We build software tools to help people understand which tax mitigation structures may make sense for you, help you understand the value on a qualitative and quantitative value basis, and the trade-offs so you can make a decision as to whether or not there are options that can help you and your family better build your wealth. And then we use technology to automate the setup and administration so it's a better experience, lower cost, more accessible. And really the broad idea is how do you help everyone build wealth in the way that in today's world that only billionaires typically have access to. Peter, do you want to give a quick kind of overview of your background?
Yeah, so my background is I'm a trust and estates attorney. I joined Valur a year ago, but at Valur I'm the head of estate planning, and so I've been building out a lot of the trust side of Valur's offerings, including some of the stuff that we're discussing today.
Amazing. And as I kind of mentioned, I founded Valur, and it was, for me, I was fortunate. I worked for a startup that did well and was IPOing. And as I mentioned, I lived in California, and I know we have a couple people joining from California. California has a lot of amazing things. One of the less amazing things is high taxes. And that's what kind of really helped me push me in the direction of having read stories about how billionaires are legally able to avoid taxes, trying to figure out how I could do that, and realizing today's world has historically not made that accessible, and what drove me to start Valur. So today we're going to kind of start with the basics of charitable giving to help you understand what it is, some of the common things that there are between different charitable structures, as well as some of the differences. And then we'll dive into what are the different structures, what makes them different, what's kind of the core use case when they make sense, really going to this core structure of today when people think about charitable structures, they think of foundations or donor advised funds, but there's a lot of other structures and each of them makes sense in different scenarios. Really want to help you understand when do they make sense. And then we'll go into kind of a case study to help you understand what are the financial implications of if you use all of these structures in the same scenario. And then we'll leave time for Q&A at the end. But again, let us know if you have questions as they come up or right now, and we'll try to address them as you share them. So let's get started. Kind of charitable giving, it's more than philanthropy. People think of it as philanthropy, and that is always a part of it. There is some level of philanthropy. And this example of this, when you gift assets to a charitable entity, you're going to get some form of charitable deduction. In many cases, when people think about it, it's 100% of the value that you donate. So if you give $100,000 to a charitable entity, people think you always get a $100,000 charitable deduction. It's not always that way. In some cases, you get 10% of that value. So in this case, $10,000. So it can range there. And this also ties to how philanthropic to how personally focused the entity is. In addition, whether you legally always have specific control as to who ends up getting the money from a charitable point, even if you don't legally, in most cases, even if the structure doesn't give you that power, the people who are controlling it typically allow you to control who the specific beneficiaries are. Are there any other similarities I missed there, Peter?
No, I think that pretty well covers it. Obviously, we're getting into a lot more detail about the different strategies, but yeah.
Maybe you want to jump into kind of like what are some of the differences between these charitable structures, just at a high level?
Yeah. So as you were alluding to earlier, so some of these strategies, there's 4 strategies. So there's donor advised funds, there's private foundations, there's charitable remainder trusts, or charitable remainder trusts more generally, and then there's charitable lead trusts. And so DAFs and private foundations are more on the pure charitable side. You do get a some kind of tax deduction, but it doesn't make up for the amount of money that you've given away. And then CRUTs and CLATs have some amount of charitable benefits, but also sort of a personal or familial component where you or your family are also getting something back from the trust in the form of either income distributions or remainder interest of some sort. So that's kind of, to me, that's kind of like the basic distinction. And then there's also some vehicles give you more control and some give you less control. And so a donor advised fund, you technically don't control anything that happens inside of the fund. And so like in theory, they could, if you set up a donor advised fund at Fidelity, Fidelity could decide how they want to invest the money, how they want to make distributions. In practice, they give you a lot of leeway, but it's technically not under your control.
Yeah, and just the other piece that you call this out is there's a difference between how philanthropic they're focused to how personally or familial the benefits are. The other piece that differs is even if they are personally focused for you or you and your family, there's differences as to when you and your family benefit. Some of these structures, you and your family can benefit every single year on an ongoing basis. In other cases, you may not benefit really. You may benefit at the beginning and at the end, but not in between. So there's kind of a different things as to when or in some cases, the charity gets all the money up front. In some cases, the charity only gets the money at the end. So timing, there's in addition to who benefits, there's when they benefit is another kind of lever that's different between these structures. So now we'll jump into kind of let's go into like, what are these structures? Maybe Peter, just want to give kind of a quick overview on these. And I think this also follows the idea of, we'll start kind of maybe on the left of these are most philanthropically focused to on the right side is personally / familially focused.
Yeah. So So we're going to go into each of these four strategies in a bit more detail on later slides. But basically, donor advised fund. This is definitely the most common of the four, the one that people are probably the most familiar with. So this makes the most sense for smaller charitable gifts, where you're really just trying to support charity and also get a tax deduction, but mostly you're focused on supporting a charity. And if you're trying to give $20,000 to charity at the end of the year, a donor advised fund makes a lot of sense. If you're trying to give $1 million to charity at the end of the year, a donor advised fund might not make as much sense. And so the
And
sort
one
of
thing that,
sorry.
no, I was gonna say the one thing to add is, and I think that's like a really key point is historically, if you were giving a smaller amount, your kind of options were to give directly to a charity. What donor advised funds really opened up is if you don't know which charity you want to give to, or you don't want to necessarily give it this year, but you want, let's say, charitable deduction, donor advised funds, they used to be expensive, but them really becoming commoditized has really enabled smaller charitable gifting when you're unsure of which charity or exactly when you want to gift it. Is kind of the avenue that's opened up.
Yeah, DAFs actually, they've been around for about 100 years, but they weren't common until the 1990s when Fidelity started to offer them on their platform, and so now they become really ubiquitous. You can get them through Fidelity, you can get them through Vanguard, you can get them through Schwab. Basically, all the large financial institutions offer them.
Yeah.
So.
Yeah, and that's kind of one thing, and a little not to plug Valur too much. That's really what we're trying to do with some of these other irrevocable trusts is what Fidelity's done to DAFs to make them accessible. What we're trying to do for these other tax mitigation opportunities. Maybe we want to jump into kind of private foundations of kind of where that fits in.
Yeah, so private foundations, a little bit like DAFs in the sense that they're basically charitable only, but they can make more sense for people making larger gifts. And so we'll get into all the various benefits of private foundations in a second, but basically, whereas with a DAF, you don't really control anything that happens inside of the DAF. You can only make recommendations. With a private foundation, you can have a lot of control over what's happening inside of the foundation. And so a lot of people prefer private foundations over DAFs for that reason. They're also more flexible. And so DAFs, you're sort of limited in what you can do charitably. Basically, you can make distributions to the Red Cross or a university from your DAF, but you can't make distributions to individuals. You can't make distributions to foreign charities that wouldn't qualify as charities under U.S. law necessarily. So like, there's a charity, and let's say there's a charity in India, and you want to give that charity money, but it's technically not a qualified charity under U.S. law. You can't support that charity from a DAF, but you might be able to from a private foundation. So that's the sort of an appealing piece of it.
Yeah, I'd say so. There's a flexibility, and the other piece is there's the opportunity to, because you can be more involved, you can get your kids or family members involved in the charity. Typically, if you have a foundation, it's less about the salary they get paid, but that they can actively run this, work to like implement and kind of spend that money on the charitable things. And then you also see people will use this for, whether it's kind of branding of putting your family's name on things, or that it's your family's foundation. It's a way to kind of keep your family prominent, or, kind of a social and branding value in the community as well. But again, a lot of that, it's a kind of higher ticket size. Maybe want to jump into kind of CLATs and kind of when they're typically used.
Yeah, so CLATs and CRUTs kind of go together. They're similar vehicles. They're both what's called a split interest trust, which is a trust that's for the benefit of both an individual and also a charity, or multiple individuals in charity. And so with CLATs, the idea is you put assets into the trust. The trust pays charity an annuity amount every year for a predetermined term. So let's say it's a 25-year term. the CLAT will pay the charity an annuity every year for that 25-year term. And then at the end of the term, whatever's left over passes to either it comes back to you or it goes to your kids typically. And so that can be pretty powerful for a few reasons. One is essentially you're getting the same tax deduction up front that you would be with a DAF or a private foundation. But you're also getting a remainder interest back, or your kids are getting a remainder interest. And so it's not purely charitable like DAFs and private foundations. There's also a personal benefit that can come back to you. So
Yeah.
And then CRUTs are sort of.
I was going to just say one other thing with CLATs is you typically want to have a longer time frame for them to make sense. At the short end, we probably see a decade, I would guess. The longer end, you'll see these things set up for 25 years. Is that kind of fair to say? This isn't something you set up for 2 or 3 years.
Yeah, it's definitely a longer term thing. Even 10 years is pretty short for a CLAT, although it's possible. I think probably most CLATs are more in the 20-25 year range. And then CRUTs, it's a different type of split interest trust, but instead of the charity getting annual payments, you get annual or quarterly or monthly distributions from the trust. And then at the end of the term, which might be 20 years, might be your lifetime, whatever's left over goes to charity.
And just one piece to call out is CLATs, they can be personally beneficial. So like, even if you don't care about the charity, you and your family can come out ahead just on a pure dollars basis. Now, in many cases, you typically want to do a CLAT if you have some charitable intent and we'll show this, and kind of want some personal familial benefits. And one thing to call, CRUTs can almost be entirely selfish, where you may not even be a philanthropic, but you'll still use a CRUT to sell appreciated assets. I know there's some questions on CLATs, so we'll jump into that in a second. Maybe we'll just do a little bit of starting with the donor advised funds and just some kind of pros and cons. At a high level, donor advised funds, they make sense when you want to give to charity, but want to do smaller amounts, typically under 500,000, and you don't necessarily know which charity you want to give to right away. You may want to give to multiple charities or give it over time. They give you some flexibility there. Maybe we want to, Peter, just run through some pros and cons.
Yeah, so pros and cons. So probably the biggest pro is, the two biggest pros are simplicity and low cost. And so right now, if you want to set up a DAF, you can go to your broker, probably if you use Fidelity or Schwab or Vanguard or really any of the major brokers. They'll have their own donor advised fund services. And so you can just set it up through like an online onboarding. It'll take a few minutes. You'll have your DAF, and then you'll be able to directly contribute to it once the account's open within a couple of days. Yeah. And so it's easy. There's no filings. You don't have to file like a tax return or anything. That's all taken care of. And it's pretty low cost. There is like they do charge you an AUM fee basically, which might be, I don't know, 60 basis points depending on the provider. And so there's some administrative overhead, but it's pretty set it and forget it. Not a ton of rules. You don't have to make annual distributions. You can sort of contribute money and leave it there for 5 years before you decide which charity you want to support. And so it's pretty low maintenance, pretty simple. And the fees scale pretty well with account size. So if you contribute $20,000, the fees are going to be really low in absolute terms. And if you contribute, $1 million, the fees are going to be a little bit higher, but still not crazy. So a lot of people like DAFs just for sort of the ease of funding them, and
I'd say ease of funding, setup, funding, and ongoing administration. It is pretty carefree. You don't have to worry about a lot of burden at any point with a DAF.
Yeah, and the other thing is, I think over the last 25 years, people have gotten really familiar with donor advised funds, and so it just sort of became the default strategy that people use when they're gifting to charity. And
but that's to say, even though it's the default,
Yeah.
this is one of the things. It's not right for every scenario, and that's really one of the things we want to drive home is there's a bunch of these different charitable structures, and they make sense in different scenarios. DAFs have become, because they've become cheap and easy, people just think of it, and it may be right for you, but it doesn't mean it's right for every scenario.
Yeah.
So.
Yeah.
Now, when does it not make sense? Or I guess, what are the downsides of a DAF?
Yeah. So the downsides, as we were talking about earlier, I think that the two really big downsides compared to other strategies is you don't have control over what happens inside of the DAF, and so there's actually been some court cases about this where people got upset about the DAF administrator doing stuff that they thought was not what they wanted to do. So like there was one case back in maybe 2019 or so that got a lot of press, where basically this guy had appreciated assets, and I think it was maybe it was his company, but it was a very concentrated position, and he contributed it to a DAF, and it was a huge dollar amount, like tens of millions of dollars, I think, and he wanted them to hold it for a certain amount of time and then sell it at the right time, based on something like he had some insider information or something about when it was going to be worth more. And so he wanted them to sell at a certain time, and I think he told them that. But then they just went ahead and sold the stock like immediately. And then he sued them, and he was like, "That's not what I wanted." And basically, long story short, he lost because it wasn't in his control, and they said that the charity acted reasonably by selling the concentrated position. So that's one of those things where if you had a different structure, you might have been able to retain that interest for longer and just decide when you wanted to sell it.
Yeah, and just in the interest of time, really, this is with a DAF. It's easy, makes sense for smaller donation amounts, but you don't have control over it. There's no direct personal benefits. You don't really have legacy building. You're not in control of it, so you just have to kind of be aware of that. Low maintenance. Let's go to kind of higher maintenance, but a much more controlled structure. Again, private foundations, you typically want a higher donation amount. You're also required to donate 5% a year. With the DAF, you don't have to donate anything, but there's a lot more overhead and control that you get with a private foundation. Maybe we want to kind of run through that, Peter. Of the pros and cons here.
So exactly, it's more regulated. There's actually proposals in Congress that have been sort of sitting around for a few years that would make DAFs regulated in a way more similar to private foundations. And so, like, if that legislation passes, DAFs would also have to contribute, something like 5% to charity each year. But for now, DAFs don't have a distribution requirement, and private foundations do. So they have to distribute 5% a year. You can include overhead costs, operating expenses as part of that 5%. So it's not exactly 5%, but it's basically, if you have $1 million in the private foundation, $50,000 has to come out every year in one form or another. And so you can't just sort of like pile money up in the private foundation account the way that you can with the DAF. But you retain a lot of control. It's usually the way they're set up is it's like you name yourself, maybe your spouse, maybe your adult children, maybe your siblings or something as directors or trustees, and together you make decisions about when you're going to make distributions, what you're going to invest in, all sort of administrative and operational stuff. Which charities you want to make grants to, and sort of you basically control your own adventure. And so there's a lot of flexibility. There's types of charitable giving that are possible with private foundations that aren't possible with DAFs. So I mentioned earlier, foreign charities you can support through a private foundation. Sometimes you can create individual gifts to individuals, basically. So you can set up, maybe like a scholarship fund through your private foundation, and say, you're creating a scholarship for, underprivileged children from.
And by the way, I want to call it this. This is one of those. It's an interesting thing to call out, but this is where it's like, it is a use case that how you can use private foundations for more personal or familial benefits beyond the salary or the prestige for your family or people that you care about. And maybe just keep going, Peter. But I just want to call it.
So
private foundations, this control gives you more ability to create familial or personal benefits.
Yeah, I mean, so there's a lot of limits. So like you can't like make a charitable gift to your kid or something like that. That would be totally disallowed.
Yep.
And also you can't, like, there's been cases where people tried to create very specific classes of people that were like, it was like Hungarian American children ages like 15 to 17, like very, very narrow classes that only their family members qualified for. And that's also been disallowed. But as long as you create like a legitimate, it's like a legitimate charitable gift, and it's not for a very specific person, then you can design it. You have a lot of flexibility in how you can design it.
Yeah. And maybe let's go on to the cons, just in the interest of time.
Yeah. So there's more complexity. So you have to file a couple returns. There's a return when you set it up called a 1023 that you have to do to apply for charitable exemption. And then every year there's a form called a 990, and sometimes state forms as well. They have to file, and those forms are actually public, and so like other people can look up your private foundation, and they can see if you're being paid, they can see how much you're being paid, they can see which charities you support, stuff like that. A lot of it is not super private. There's also there's lower tax deduction limits, charitable deductions are limited to a percentage of adjusted gross income. And so if you contribute, $1 million to charity, the charitable deduction in the year of the gift for a DAF is going to be limited to 30 or 60% basically of your adjusted gross income, whereas gifts to a private foundation are going to be limited to 20 to 30% of your adjusted gross income, depending on some details. And so it's a lower adjusted gross income deduction limit. You can roll those over into subsequent years for up to 5 years. But there's some cases where you could have gotten a full deduction with a DAF, but you can't with a private foundation until a subsequent year. And then private foundations are subject to an excise tax that DAFs and other charities aren't. It's basically specific to private foundations. And so it's not a huge tax. It's 1.39% of net investment income, but it adds up a little bit over time. So that's another downside.
Yeah. And then to keep going, so Charitable Lead Annuity Trust, and there's a couple of questions on this, so maybe we'll just give an overview. Charitable Lead Annuity Trust, the key part is you set up a Charitable Lead Annuity Trust for a set period of time. And so as Peter mentioned, let's say you put $1 million into, these are called CLATs for short. Put $1 million into CLAT, you'll typically receive $1 million charitable deduction, similar to DAFs or foundations in that piece of get the same deduction. The charity doesn't get that $1 million up front. When you set up the CLAT, what happens is every year, the CLAT is going to gift a certain amount to charity over the length of the CLAT's term. If the CLAT is set up for 10 years, over the 10 years, every single year, the CLAT will give amount to charity. And there's kind of and so that's kind of the benefit to charity is they're getting essentially an annuity stream. This is where the name Charitable Lead Annuity Trust comes from. They're getting an annuity for a set period of time from the trust. Now, there's a lot of nuance to this, but one piece is, it doesn't have to be the same, and I'm just pulling up some of these questions, it doesn't have to be the same charity every year. It could actually be multiple charities in a given year. You could split up. The CLAT has to give a certain amount to charity every single year, but that full amount doesn't need to go to one charity. It could be split up between multiple charities. It could change from year to year. The only thing that's fixed is the amount that goes to charity from the trust.
Yeah, what a lot of people do is they name a donor advised fund as the charity for their CLAT, and then that means that then you're getting money into the DAF, and then once it's in the DAF, you get to decide how you want to spend it, and so that's a way to have a lot of flexibility going forward. And so you're just making annuity payments to the DAF.
Yeah. And then just kind of jumping through the pros here, and let me know what I'm missing here. With the CLAT, you get the same charitable deduction as a DAF or foundation. Some nuances about how much you can apply in a given year, but it's the same. Put $1 million in, you're getting $1 million charitable deduction. In addition, your family can benefit from this. You're getting the tax savings from the charitable deduction, but the way CLAT works is every year, you put $1 million in, every year a set amount is going to charity. And then what's left, which is called the remainder, after if it's set up for 10 years and every year is paying out a certain amount to charity, that remainder can go to your family. And it typically can pass to your family without using your annual exclusion or gift exemption and pass to them estate tax free. So it can be a really efficient way for families that are worried about the estate tax and charitably inclined to give money to a DAF or a foundation and also pass on money to their kids or trust for their kids and future generations tax free. Am I missing kind of any big pros?
Yeah, those are the big things to hit.
Yeah. So there's now the cons tend to be there's only a remainder left in the trust if you do well investing the kind of assets in the trust. So typically kind of what we call a hurdle rate of there'll typically be a remainder left if you're investing the money in the trust and it's getting a better growth return than treasuries, which for most people over a decent period of time is fairly, is kind of expected, but it's not guaranteed. There's also annual tax filings compliance with CLATs. So, and it typically makes sense for people who have a long-term plan because, again, as Peter mentioned, there's a longer time horizon with them.
Yeah.
So, and it involves typically passing on to your kids. So you just need some kind of planning involved for this to really think through the implications. Any kind of big pieces we're missing here?
No, I think those are the main things. So we got a question about CLATs. Can charity be given to non-U.S. charities? So the short answer is if the charity doesn't qualify as a U.S. charity under U.S. tax law, then the only way to do it is if you name a private foundation as the charitable beneficiary, and then the private foundation can then make distributions to that foreign charity. But assuming no private foundation involved, the answer is no. If the foreign charity doesn't qualify as a charity under U.S. law, if it's not a 501c3, then you can't make distributions to it.
Let's move on to Charitable Remainder Unitrust. This is so there's
this is another question related to CLATs. He's saying
it can also be related to CRUTs, but we'll get into that on the next slide.
And can money be invested in anything? Real estate, PE. Maybe we should tackle this after we talk about CRUTs.
Yeah, we'll save this for the end. Charitable Remainder Unitrust. So this is a commonly used structure to sell appreciated assets. This is everything from Phil Knight, the founder of Nike, sells Nike shares in this. It's essentially, again, it's a tax-exempt trust. It's very similar to an IRA where you can sell the assets tax-free in them, reinvest the money pre-tax, grow the assets pre-tax, and you only pay taxes when you pull the money out of the trust. And so really the core benefit of this is if you're selling appreciated assets and you lose a big chunk of the sale to taxes, you can defer those taxes, reinvest those taxes, and because of compounding can create a lot more value for you and your family up front. And so that's kind of really the core principle. And the biggest pro is that tax deferral. If you're selling if you're in California you're selling $1 million asset with zero cost basis, you'd otherwise lose roughly $350,000 to federal and state capital gains taxes. So, but instead, if it's inside a CRUT, you can defer those taxes, reinvest that money, and that $350,000 is going to create more wealth for you and your family by being reinvested. And you only pay the taxes down the line as you pull money out. Now, with these other structures, we mentioned that if you put in $1 million, you get $1 million charitable deduction. With the CRUT, you typically get around 10% of that value. So you put $1 million in, you get $100,000 charitable deduction. It can be more, but in most cases, it's about 10% if you want to maximize the benefits for you and your family. Did I miss any kind of big pros there, Peter?
No, yeah, those are the key points.
Now, what are the cons for CRUTs?
Yeah, so for CRUTs, so the benefit, first of all, the benefit to charity is not as substantial as the benefit to charity of these other strategies. And so if you give $1 million to a DAF or a private foundation, that's $1 million that it could spend tomorrow, or next week. If you give $1 million to a CRUT, it's only going to get a fraction of that, and it's not going to get that money until the end of the charitable term, the end of the Unitrust term. So if you do a 20-year term, the charity is not going to get anything for 20 years. And so it's, if you're trying to support a charity tomorrow, it's not going to help. But if you're just sort of generally interested in both tax efficiency and also it's also this great benefit for charity, then it can make a lot of sense.
Yeah. By the way, just even call us out. We work with a lot of people who don't even it's great that there's a charitable aspect to this, but they don't choose to use these CRUTs because the charitable aspect they're solving for themselves. Yeah. So that is a big piece. Another common thing is you can set this up for your life, you and your spouse's life in many cases, depending on how old you are. Now, there's an interesting kind of question. Let's go back to CLATs here. There's a question as to, in a CLAT, what is the minimum amount you should give to be charity to be compliant with the IRS? 1 million, 50K. There's actually no set number. And I'll explain how the CLAT works. So let's say you put $1 million into a CLAT. We mentioned, hey, you can get $1 million charitable deduction. Really, the way that this works is that let's say you set up the CLAT for 10 years or 20 years. Every single year, you're gifting a set amount to charity. It's in the trust document as to exactly how much that is. Now, or the percentage of the trust assets it is. Now, the critical piece is that I'm just going to explain something of what discount rates are. Your charitable deduction is essentially the net present value of every future year's charitable donation from the trust. So in other words, and just a simple kind of basics of everyone here would rather have $100 today than $100 a year from now. And that $100 a year from now is worth less than $100 today. So essentially what the IRS does is they use what's called, we've mentioned this a couple of times, it's a 75-20 rate. It's pretty similar to treasuries, not exactly, but roughly in that neighborhood. They use that to essentially discount future cash flows. So they'll say, using the 75-20 rate, let's say it's about 4% right now, they'll say that, $100 a year from now is actually worth $96 today. And they'll apply this every year out because the trust document has listed out what is the charitable donation for every future year. The value based on the government's discount rate, that 75-20 rate, that's a charitable deduction today. So you could give less to charity in the trust document, but your charitable deduction will be lower. So these things are intrinsically tied together. And so this is where, when we're talking about, you have this hurdle rate, there'll only be a remainder left if when you invest the assets in the trust, they grow faster than the hurdle rate. And one thing to kind of call out is in these CLATs and CRUTs, you generally have a lot of flexibility in terms of what you can invest in. It can invest in stocks, bonds, private equity in most cases, real estate, unless there's leverage, at least in the sake of CRUTs. There's a lot of flexibility, alternatives. Really, Peter, you want to jump in there?
No. I was just gonna say, there's a lot of flexibility. There's some limitations, especially with CRUTs, but the vast majority of things that you can think of are totally kosher for investing. And for CRUTs, you're actually the trustee, so you're the one making the investment decisions. For CLATs, you might be the trustee, you might not. It's a little bit complicated, but yeah, there's a lot of there's a lot of flexibility in terms of what you invest in.
Yep. And then we're going to jump into kind of a case study. One last question here. Sounds like CRUTs are like IRAs, but without a limit as to how much money is put in, and we define the terms, not their time names. That's correct. With CRUTs, there's no limit to contributions. You can add contributions. You can add different types of contributions. You can contribute stock, crypto, real estate. We've seen all of those. We've seen art. We've seen collectibles. We've seen kind of the whole range, and you can do all those into the same trust. And then you're entitled to distributions every year. There's ways that you can defer those, and you can set them up for a specific number of years, your life, multiple people's lives, depending on how old you are. But there's a lot more flexibility. The big downside is you can't pull out everything at once. So, but let's jump into kind of, we want to just give you an idea of how do these, we talked about, DAFs really make sense for smaller donations, where you want ease of use. Foundations make sense for larger, where you're philanthropically focused, but you want more control or personal and some family kind of branding benefits. CLATs are, you kind of want a mix of personal, family / philanthropic things. CRUTs tend to be more personal and familial benefits than charity. Take a study of John and Mary are from California. They're married with 3 kids. They have $10 million in NVIDIA shares with $1 million cost basis. One of their goals are they want to sell these shares as tax efficiently as possible. Big concentration risk having most of their net worth in one stock. But they also do want to support charity. But there's a balance of some charity and some kind of distribution themselves. Now, really kind of, and also these, we're going to see what are these, if they use each of these structures in 25 years, where do they end up? Assuming that after they sell the NVIDIA shares, they reinvest the money and it grows 9% a year. So, and this really kind of goes to, when you see these numbers, which charitable structure you choose depends on your goal. If you look at this, if you use a CRUT, kind of in 25 years after taxes, your family would get roughly about $47 million with a CRUT compared to $2.5 million with a CLAT or $0 with a DAF and foundation. On the other hand, if you look at how much does a charity have in 25 years, if you use a DAF or foundation, they'll probably have about 77 million versus 39 million with a CLAT versus 18 million with a CRUT. So it really goes to this thing of which charitable structure you choose depends on your goal. You and your family are going to benefit most with a CRUT if you have an appreciated asset, versus a charity is going to benefit the most with a DAF or foundation. And again, the size of your donation, and if you care about kind of overhead or the branding, that's going to help determine which of the DAF or foundation makes sense. The CLATs are kind of a middle ground. Any other things that you think are kind of important to call out here, Peter?
Yeah, this example is just very the way that the example is structured. It's very favorable to a CRUT and very unfavorable to a CLAT. And so, like, if we change the assumptions, the CLAT could look a lot more attractive than the CRUT. Basically, you don't want to.
Well, sorry, when you say attractive, you mean in what way?
Potentially personally, but also, so like, example, like the $46.7 million going to you personally versus the CLAT being $2.5 million. Those numbers could be a lot closer.
They'd be closer. The CRUT would still be, well, it depends if it's an appreciated asset or not. A CRUT's only going to make sense if it's an appreciated asset.
Yeah.
A CLAT, and this is, I think, a core thing, easier way to say this.
Yeah.
A CRUT really makes sense if you have an appreciated asset. You typically don't want to fund a CLAT with an appreciated asset. You'll typically fund a CLAT with cash or assets that are very close to their basis, but you won't fund a CRUT with those assets. And so that's kind of also a divisive factor that sends you down one path or the other.
Yeah. Yeah, but anyways, just so people know that CLATs can also be be pretty attractive.
Yeah, and that's kind of just the key thing is depending on kind of the asset that you're funding it with, and that's why I really want to focus on when do each of these make sense, is your goals and the types of assets, whether it's cash or appreciated asset, that really can help drive what you use. Now, there's a bunch of questions, we're going to get to that. Just as a quick thing, if you want to learn more, you can visit us at Valur.com or learn.valur.com. We have a lot of content. We also have tools. We have this guided planner tool where there's just time I'm not going to show that, but if you search Valur's guided planner tool, it'll help you figure out which structure makes sense. It's a few questions to help determine what are your goals, type of asset you have, and it'll help determine which structures are likely to kind of the best fit. And then we also have calculators that can help you understand exactly all the numbers you saw there. They're from our calculators, can help you understand how much you would get, how much a charity would get, how much you'd benefit over what time frame. You can adjust growth assumptions, do all of that. There's no cost to any of this. You can also set up time with us at Valur.com schedule if you want to chat with us more to learn more. And now we'll kind of jump into some Q questions that are here. There's a question of what's the cost to set up and operate a CRUT? So you can set up a CRUT in 15 minutes for no cost. If you go to Valur.com, create an account, we enable you to set up these CRUTs for free fairly quickly. And then part of the way that we make money is we charge for the trust administration. We do the accounting, tax filing, and administration. We'll help you optimize the CRUTs, manage it, and take care of all the overhead. And that's typically about $5,000 a year for that with no upfront costs. Another question here from, can these trusts pay compensation to family members for administration?
So they can, but you have to be really careful. So there's rules about self-dealing with charities and charitable trusts. And so the answer is that in theory, as long as the compensation is reasonable, you can. But if you put $1 million into a charitable trust, the reasonable compensation is going to be a tiny fraction of that. So like you can't put $1 million into a charitable trust and pay your kid $100,000 a year to be trustee or something. Like it has to be a very small amount of the overhead. Anything significant is going to look like self-dealing that will disqualify the trust. So in most cases, people don't pay the trustees for compensation or like any family members. You can't. You just have to be careful.
I'm just looking through to see if there's any other questions. Here's an interesting one. So I've heard some charities provide multiples of the charitable donation as a deduction. That is kind of true. I guess you could say it is true. There's this is a category. It's actually a real target area for the IRS. They're called conservation easements, fee simple, historical easements. I'll give you the broad idea on this. The idea is in most cases it involves land. Let's say you buy land that's by the coast, and if you buy that land for $1 million, you could then, maybe decide, hey, like we could build a hotel or resort on this, and you could get, an appraisal of if you build this hotel, it could be worth $5 million. It maybe costs you another $1 million to build it, or you could decide, hey, I really want to protect this land. I don't want anything to be built on it. You put an easement in it, and what that means, it can never really be built upon. And the IRS gives you a deduction for the lost value because you could have built this hotel that would be worth something minus the cost. And so they give you a deduction for that. Now, this area has become so, it's part of the tax code. So it is something that is in there, but it's become something that's so exploited that the IRS, it's on what's called their dirty dozen list and something that they actively target. And they will, they essentially automatically audit these as a default. I think there's maybe a small chance that changes, with the new administration, maybe not. But as of now, if you do this, you're essentially you're signing yourself up. Well, whatever fund is handling this is going to sign itself up for an audit, which can put your deduction at some potential risk. Did I miss anything with that, Peter?
Yeah, that's right. And then I don't remember if we addressed those.
Yeah, we did. It's
Sid has a question. So I'm not sure if he means like 5% a year, or if he means like a 5% hurdle rate.
Yeah. So I guess the short answer is, so the answer is you'd likely have a remainder left if they asked us to grow at 9% a year. That remainder would go to your kids. you typically don't set this up you can set this up so that essentially 5% of the initial value goes to the charity. Typically, what you'd set it up as, it's a slightly different formula, but if it grew 9% a year, the current 75/20 rate, the one thing is how long you set the trust up for. The longer CLATs have a higher personal or familial return. One, the longer you set them up for, the higher your growth rate. So if you set up for 25 years with a 9% average return, there would be a remainder for your kids.
So he clarified 5% a year. So if it's 5% a year, there's going to be a gift to your children, just because the 5% a year is almost certainly not going to be enough to sort of meet the IRS formula's requirements for distributions to the charity without there being a taxable gift. And so depending on the term, you'd probably want more like 7 or 8% to go to charity each year. And so at 5%, some portion of that is going to be a gift.
And by the way, what Peter's saying is, in the case if you did 5% a year, there'd almost definitely be a remainder that goes to your children, but some portion of that would count as part of your gift, your lifetime gift exemption, that and could potentially trigger estate taxes. Yeah. Typically, when you do a CLAT, you set it up so that according to the government's discount rate, you're not actually expected to gift anything to your children. But if you beat that hurdle rate or your assets grow 9% a year, there will be actually something left as a remainder. And even though that does go to your children, it doesn't count as a gift. There's no estate tax on it. Yeah. So then there's a question here from Michael as to, so this is it again. With Charitable Remainder Trusts, you can set them up either for a specific number of years, between 2 to 20 years, or for people's lives, or a combination. For instance, you could do the longer of someone's life, or 20 years. As long as they're not too young, you could do that. If someone died, let's say they set up for 20 years and they pass away, typically what happens, and the default that we set our trust documents have, it will follow your will. So if you get hit by a bus in year 10, after that, for the remaining 10 years of the trust, it'll follow your will into whether your spouse or kids, whoever you've named, your dog. I actually don't know the dogs. Maybe dog's not.
Yeah, not your dog. But okay, basically, typically, if you do a term of years, like 20 years, and you die during the 20 years, you'll say, in the event that I die before the end of the 20 years, I name my spouse or name my kids as the beneficiaries, and they'll be getting the benefits until the end of the term.
Yeah. Another great question here from Paul. So are there estate planning benefits putting appreciated assets in these vehicles versus just passing the asset on a step-up basis? This is a great one. There's a lot of different angles to this too. So, and I think it depends on what you're solving for.
Yeah, so you don't really want to put the appreciated asset into CRUT, into a CLAT. You do want to put it into a CRUT, because the CRUT can defer capital gains tax on the sale. So I would say
depends if you're going to sell it. So one question is, are you going to sell this asset or not?
Yeah,
right.
Yeah. If you're not planning on selling the appreciated asset, then it probably makes sense to hold it until you die and get the basis step up that way. If you're planning on selling the asset anyways, then a CRUT can make a lot of sense, because you wouldn't have gotten the basis step up because you would have sold it. So that's the short answer.
But yeah, and one other wrinkle here is, let's say you're close to the estate exemption or worried about estate taxes, you may want to get into another type of trust, whether it's called an IDGET or non-grantor trust, so that, let's say you expect it to appreciate a lot over the next decade. Then you may want to get outside of your estate to reduce estate taxes. So it depends on if you're going to sell it, what is your potential estate tax liability, and what is the composition of the assets in your estate? Because if this is highly appreciated, you may keep this in your estate and move other assets outside of it. It depends.
Yeah, sometimes for estate tax planning purposes, because the estate tax is generally a heavier tax than the capital gains tax, sometimes it makes sense to just sacrifice the basis step up for estate tax savings. But yeah. Yeah,
and just as a kind of just 30 seconds on that, capital gains at the high end, I'm going to assume long-term capital gains are about 35%. The federal estate tax, if you're over the limit, starts at 40%, and then you can add state estate taxes on there. So it can be north of 50.
Yeah, and it's
why
40% of the entire net value, not 40% of the appreciation.
Yes.
And so it can easily be a lot higher.
Yeah, and this is why Peter's point is to sometimes no one likes taxes, no one likes capital gains taxes, but sometimes you're willing to sacrifice that to avoid estate taxes because that's one, just not on appreciation, it's on the whole asset, and it's a higher amount. So want to thank everyone for joining. A lot of great questions. And again, if you have more questions, you can visit our website, you can email us, you can set up time to chat about these structures, and really great questions, and let us know if there's other topics that you're interested in learning about. But thanks for joining today, everyone. Take care.